Right now, at this very moment, thousands of traders across the United Kingdom are walking into what could be the costliest mistake of their investment lives. They're paying $117, $120, even $130 per ounce, convinced they're securing their financial future. But here's what the dealers won't tell you. The moment you hand over your money, you've already lost 38% of your capital. Gone. Vanished. Before you even walk out the door. And the truly disturbing part? Most of them will never realize it until it's far too late. The numbers don't lie. But someone needs to decode them. Welcome to John Analyst. If you've been around long enough to remember when a handshake meant something in business, when contracts were built on trust, not fine print, then you know the value of straight talk in a world full of sales pitches. That's exactly what we do here. Now, before we go any further into this analysis, do me a favor, would you? Hit that subscribe button just below this video. Think of it as marking your spot in a library of economic truth. You wouldn't walk away from a valuable conversation halfway through, would you? Neither should you miss what's coming next. And tell me, where in the world are you watching this from today? London? Manchester? Perhaps you're tuning in from across the pond? Drop your location in the comments. It helps us understand who's paying attention to these market distortions and where the impact is being felt most severely. Now, let's expose exactly what's happening in the silver markets. And more importantly, how to protect yourself from this trap. A trader sits at his desk in London, watching the silver price ticker climb higher. $100 per ounce, then $105, then $110. His heart races, because everything he's read online tells him this is the moment, the big break. The wealth preservation play everyone's been talking about. So he opens his browser, types in Buy Silver UK, and clicks the first result that appears, Bullion by Post, a reputable company, well established, trusted by thousands. He scrolls through their website, finds the Silver Britannia coin, and sees the price. $117.72 for a single ounce. He pauses for a moment, thinking that seems high. But then again, silver is at all-time highs, isn't it? This must be normal. So he clicks Add to Cart. What this trader doesn't realize is that he's just made a decision that will cost him far more than he could possibly imagine. Not next year, not next month. Right now, in this exact moment. Let's rewind the clock back to late 2014. Silver was trading at roughly $10 per ounce. A trader back then could walk into any UK dealer and buy a Silver Britannia for around $14 to $15. The breakdown was simple. $10 for the silver itself, $2 for the dealer's premium, and $2 for VAT, the dreaded 20% sales tax that the UK government applies to silver. Total cost? $14. Not ideal, but manageable. Fast forward to today. That same Silver Britannia now costs $117.72. The silver spot price has risen, yes. But look closer at the numbers. The spot price for 1 ounce of silver is sitting at around $24 to $25. So where does the other $92 come from? This is where the trap begins to reveal itself. The dealer premium, that small $2 markup from 2014, has now exploded to over $27 per coin. And the VAT, that's no longer $2. It's now close to $20 per transaction. Because VAT in the United Kingdom isn't just charged on the silver itself, it's charged on everything. The spot price, plus the dealer's premium, plus their profit margin. All of it gets hit with that brutal 20% tax. So the trader who just clicked Add to Cart, thinking he's buying $100 worth of silver, is actually buying $24 worth of silver and paying $93 in premiums, margins, and taxes. Let that sink in for a moment. $93 in costs for $24 worth of metal. Now, here's where it gets even more concerning. If that same trader wakes up tomorrow and realizes he made a mistake and wants to sell that coin back to the dealer, how much will they pay him? $117.72? No, not even close. Bullion by Post, the same company that sold him the coin, will buy it back for $71 to $78. He paid $117s, he can sell for $71. That's a loss of $45 to $94 in less than 24 hours. A 39% loss without the silver price moving a single penny. This isn't a market fluctuation. This isn't volatility. This is structural extraction. And it's happening to thousands of traders right now. Across the United Kingdom, the charts don't lie. When analysts pull up the 15-year silver price chart, what they see is unprecedented, a vertical climb that defies traditional market patterns. But what most traders don't see is the widening gap between what dealers charge and what they pay back. In 2014, that gap was around $3 to $4 per coin. Painful, but survivable. In 2025, That gap has exploded to over $45 per coin. This isn't normal market behavior. This is a distortion, and every major UK dealer is flashing the same warning banner across their websites. High demand, delivery delays expected. At first glance, it looks like good news. Demand is high. Silver must be valuable, right? Wrong. What it actually means is that supply is constrained, dealers are overwhelmed, and premiums are skyrocketing as a result. Basic economics. When supply drops and demand surges, prices rise. But in the silver market, it's not just the silver that rises. It's the premiums. It's the margins. It's the spread between buy and sell. Everything inflates, except the actual value the trader receives. So the trader sits there, staring at his screen, his 117.72 purchase confirmation glowing on the monitor. He feels good. He feels smart. He's bought into the silver boom. What he doesn't know yet is that he's just walked into the most expensive lesson of his investing life. And the clock is already ticking. 3 weeks later, the same trader receives an email. Subject line, "Congratulations on your silver investment." It's from a precious metals newsletter he subscribed to. The email talks about silver's continued rise, about how smart investors are protecting their wealth, about the coming shortage that will push prices even higher. He smiles, feels validated. Then, curiosity strikes. He wonders, what's my silver actually worth right now? So he logs back into Bullion by Post, navigates to their Sell to Us section, and checks the buyback price for his Silver Britannia. 71.78. The smile fades. Wait, he thinks, I paid 117. How can it only be worth $71 now? Did silver crash? He frantically opens another tab, checks the spot price. No, silver is actually up slightly. It's now trading at $25.50 per ounce. So why is his coin worth $45 less than what he paid? This is the moment when the fog begins to clear, and the trap reveals its true nature. Let's break down what's really happening here. When a dealer like Bullion by Post lists a Silver Britannia for $117.72, they're not just selling silver, they're selling a package. And inside that package are multiple layers of cost that most traders never see. Layer 1, the silver itself. Current spot price, $25.50. That's the global market rate for 1 ounce of pure silver. Layer 2, the dealer's net unit price. For Bullion by Post, that's approximately $98 per coin. This is what they actually pay to acquire the coin from their suppliers. Layer 3, the dealer's markup, $117.72 minus 98 equals 19.72. That's their gross profit per coin. Not unreasonable for a retail business, right? But wait, there's still one more layer, the invisible one, VAT. That $117.72 price tag includes $19.62 in pure government sales tax. So let's add it all up. Silver value, $25.50. Dealer acquisition cost overhead, $72.50. Dealer profit, $19.72. VAT, $19.62. Total, $117.72. The trader paid $117 for $25 worth of silver. Now here's where it gets truly disturbing. If that trader decides to sell, all those extra layers disappear instantly. The dealer doesn't care about VAT when they're buying. They don't reimburse for the premium the trader paid. They only care about one thing, the silver. So they offer $71.78, which breaks down to spot price, $25.50, plus a small buyback premium, $46.28. That's it. Everything else, the $45.94 difference, is gone. Evaporated, transferred from the trader's pocket into the dealer's ledger. But here's what makes this situation even more interesting. While retail traders are paying $117 per ounce, there's an entirely different market operating in parallel, the secondary market, on platforms like the Silver Forum, a private community where collectors and investors trade directly. Those same Silver Britannias are changing hands for $95 to $100. No VAT, no inflated dealer premiums, just fair market pricing between individuals. And for larger purchases, the numbers become even more striking. A kilobar of silver, that's 32.15 troy ounces, is currently selling for $2,500 on the Silver Forum. Let's compare that to retail. Bullion by Post charges $3,187 for the same kilobar. The breakdown, silver value, $819 at $25.50 per ounce. Dealer costs and markup, $287, VAT, $581. Total, $3,187. So a trader buying from a dealer pays $3,187, while a savvy buyer on the secondary market pays $2,500. That's a difference of $987 for the exact same bar of silver, same weight, same purity, same metal, but a 28% difference in price. Now, let's take this one step further. Because there's another platform where things get even stranger. eBay. Over the past 2 weeks, kilobars of silver have been selling on eBay for over $3,000. In some cases, as high as $3,200. Why? Because most eBay buyers don't know about the silver form, don't understand dealer pricing structures, don't realize they're overpaying. They see silver at 100 plus per ounce. They panic, they think they need to buy now before it goes higher, and they click buy it now at whatever price appears. This creates an opportunity, an arbitrage play. A trader could theoretically buy a kilobar on the silver form for $2,500, list it on eBay for $3,100, and pocket $600 in pure profit. No mining, no refining, no manufacturing, just moving silver from one market to another. But here's the critical question. Why does this gap exist? Why can the same piece of silver trade at 3 completely different prices in 3 different markets, all at the same time? The answer is simple. Information asymmetry. Most retail traders don't know these alternative markets exist. They Google buy silver, click the first sponsored link, and assume that's the market rate. The dealers know this. They pay for those Google ads specifically because uninformed buyers are the most profitable buyers. And as long as that information gap exists, the arbitrage gap will continue. Our trader, staring at his 71.78 buyback offer, finally understands. He didn't buy silver, he bought a very expensive lesson, and the market is about to teach him even more. A retired accountant in Birmingham, let's call him Robert, has been watching the silver market for months. He's 67 years old, worked his entire career analyzing numbers, balance sheets, tax codes, financial statements. If anyone should understand how markets work, it's him. So when silver crossed $100, he did what any analytical mind would do. He built a spreadsheet. Column A, dealer prices. Column B, spot prices. Column C, the difference. And as he filled in the numbers, row after row, dealer after dealer, something didn't add up. The margins were too wide. The spreads were too large. Even accounting for reasonable business costs, the math wasn't making sense. Then he added one more column. Column D, VAT. And suddenly, everything became clear. VAT, value added tax. 3 letters that explain almost everything wrong with the UK silver market. In most countries, investment-grade precious metals are treated as financial assets. Gold coins, VAT exempt in the UK. Gold bars, VAT exempt. Silver coins, 20% tax. Silver bars, 20% tax. The logic? There isn't any. It's a legacy policy. From a time when silver was considered an industrial metal, not an investment vehicle, but decades later, even though silver is now widely recognized as a store of value, even though millions of investors hold it in portfolios, even though it trades alongside gold in every major market, the UK government still treats it like copper wire. Robert pulls up the HMRC guidance documents, reads through the classifications, and realizes something disturbing. If he buys a gold Britannia, he pays spot price plus a small premium, no VAT. If he buys a silver Britannia, he pays spot price plus premium plus 20% tax, same coin series, same mint, same legal tender status, but completely different tax treatment. Why? Because the government decided, arbitrarily, that gold is investment grade, and silver is not. This isn't just unfair, it's economically destructive. Let's walk through the cascade effect. A trader wants to invest $10,000 in silver. At current prices, without VAT, he could buy roughly 400 ounces. With VAT, he can only buy 333 ounces. That's 67 ounces less. A 17% reduction in purchasing power before he even starts. Now let's say silver appreciates 20% over the next year. The trader without VAT would see his 400 ounces rise to $12,000 in value, a $2,000 gain. The trader with VAT would see his 333 ounces rise to $10,000 in value, a $0 gain. He breaks even because the VATs ate his entire profit. This is why Robert, despite his decades of financial experience, despite his understanding of market mechanics, cannot justify buying silver through retail dealers. The tax structure makes it mathematically impossible to win, unless Robert discovers the silver forum. At first, he's skeptical. An online community where strangers trade precious metals. Sounds risky. Sounds like a scam waiting to happen. But he clicks through anyway, reads the forum rules, studies the feedback systems, watches how transactions unfold, and slowly, he begins to understand this isn't a marketplace, it's a community. Members have reputation scores, transaction histories, years of verified trades. The system is built on trust, but verified trust, not blind trust. Robert creates an account, spends 2 weeks just observing. watching deals happen, seeing how buyers and sellers interact. And then he sees a listing. 1 kilo silver bar, $2,500 collection or insured post, posted by a member with 247 positive feedbacks. 0 negative feedbacks, member since 2018. Robert does the math, $2,500 for 32 to 15 ounces. That's 77.76 per ounce. Compare that to bullion by post, 108 to 42 per ounce, 3,187 divided by 32.15, a difference of 30.66 per ounce. On a full kilo, that's a savings of 987. He sends a private message. Is this still available? 3 minutes later. Yes, are you interested? The transaction takes 4 days. Robert pays via bank transfer. The seller ships via Royal Mail special delivery, fully insured. Tracking number provided. The package arrives. Robert opens it carefully. Inside, a sealed 1 kilo silver bar, hallmarked, authenticated exactly as described. He weighs it on his jewelry scale, 1,000 grams. Perfect. He just saved 987 by avoiding the retail system entirely, but more importantly, he learned something crucial. The retail market isn't the real market. It's a tourist trap, designed for people who don't know better. Now Robert starts digging deeper. He discovers that the secondary market isn't just cheaper, it's more liquid. On the silver forum, sellers are getting $95 to $100 per ounce for Britannias. On eBay, they're getting $100 to $105. Meanwhile, dealers are only offering $71 buyback. So the secondary market isn't just better for buying, it's dramatically better for selling. Robert opens a new spreadsheet. This time, he maps the complete ecosystem. Buying options, retail dealer, 117 per ounce. Silver forum, 95 per ounce. eBay, 105 per ounce, risky. Selling options, retail dealer, 71 per ounce. Silver forum, 95 per ounce. eBay, 100 plus per ounce, risky. The pattern is undeniable. Retail dealers offer the worst prices. On both sides of the transaction, they're extracting maximum value from traders who don't know alternatives exist. But then Robert notices something else, something that makes his accountant instincts fire up. On eBay, kilobars are selling for $3,000 to $3,200. He can buy them on Silver Forum for $2,500. That's a potential $500 to $700 profit per bar. He runs the numbers. Buy 10 kilos at $2,500 each, $25,000. Sell 10 kilos at $3,100 each, $31,000 gross profit, $6,000 eBay fees, 12.8%, $3,968 net profit, $232 for moving silver from one platform to another. It's not a business. It's not sustainable long term, but it's a clear signal that the market is completely broken when the same asset can trade at wildly different prices in easily accessible markets with no barriers to entry. Something is fundamentally wrong. Robert leans back in his chair, closes his spreadsheet, and realizes the truth. The UK silver market isn't a market. It's a trap, baited with fear, sprung by ignorance, and profiting from information asymmetry. And the only way out is knowledge. It's 11:47 p.m. A young entrepreneur in Manchester, let's call him Daniel, can't sleep. He's been scrolling through silver forums for 3 hours, reading threads, comparing prices, watching the market move in real time. His laptop screen glows in the dark bedroom. Charts, numbers, testimonials. Everyone seems to be making money. Everyone seems to know something he doesn't. Silver hit $102 per ounce today. Tomorrow it might be $105. Next week, $110? The fear of missing out is eating him alive. His finger hovers over the Buy Now button. 2,240s for 20 silver Britannias. His savings account has $3,200. This would be most of it. But if silver goes to 150, he'd make thousands, right? Wrong. Daniel's about to make the same mistake that thousands of traders have made before him. He's confusing price movement with profit potential. Let's break down what would actually happen if Daniel clicks that button tonight. He pays $2,940 for 20 coins. That's $117 per coin. The silver spot price right now is $25.80, so he's paying $91,020 per coin in premiums and VAT. Now let's say silver does go to $150 spot. That's a 481% increase. Incredible, life-changing. Except when Daniel goes to sell his coins back to the dealer, they won't pay him $150. They'll pay him buyback rate, which historically runs about 70 to 75% of the selling price. So if dealers are selling at $150, they're buying at $105. Daniel paid $117. He can sell for $105. He's still down $12 per coin. Even after a massive silver rally, this is the mathematical trap that almost no one talks about. But let's say Daniel is smarter. Let's say he reads this analysis first. Instead of buying from a retail dealer, he goes to the silver forum, buys 20 Britannias for $95 each. Total cost, $1,900. Now, when silver hits $150 spot, and he sells on the secondary market for $120 per coin, he makes $25 per coin profit, times 20 coins, that's $500 profit. Same silver rally, same metal, but a completely different outcome. Why? Because he avoided the retail trap. He didn't pay the VAT penalty. He didn't pay the inflated dealer premiums. He entered the market intelligently. Now here's what's happening right now. Across the United Kingdom, dealers are reporting unprecedented demand, not just high demand, unprecedented. Orders are backlogged by weeks. Some dealers have stopped taking new orders entirely. Phone lines are jammed, websites are crashing under traffic. This isn't normal market activity. This is panic buying. And panic buying always creates the same pattern. Premiums explode, spreads widen, liquidity dries up, and retail traders get crushed because they're buying at the peak of the panic with the worst possible pricing and the lowest possible chance of profit. Professional traders know this. They know that when everyone is buying, it's time to sell. When everyone is panicking, it's time to be calm. When premiums are at record highs, it's time to wait. But most retail traders don't have that discipline. They see the price going up. They see the headlines screaming about shortages. They see social media filled with success stories, and they panic. Daniel almost did. He almost clicked that button, but something stopped him. A small voice in the back of his mind, asking a simple question. If this is such a good deal, why are they advertising it so heavily? That question saved him. Because the truth is, when dealers are pushing hard, when they're running Facebook ads and Google campaigns, when they're sending email blasts about last chance opportunities, they're not doing you a favor. They're doing themselves one. Let's talk about timing. Because timing is everything in precious metals. Robert, the accountant from earlier, he bought his kilo bar for $2,500. That was 3 weeks ago. Today, that same bar is selling for $2,700 on the silver forum. He's up $200. Not because he's a genius, not because he timed the market perfectly, but because he bought intelligently. He avoided the retail markup. He avoided the VAT. He bought from the secondary market. And now he has options. He could sell on the silver forum for $2,700. Quick $200 profit. He could list on eBay for $3,200. Potential $700 profit, but with risk. Or he could hold. Wait for the next wave. See where the market goes. The point is, he's in control because he didn't enter the market with a 40% hole to climb out of. Now let's talk about the dealers themselves, because there's something important to understand. They're not the enemy, they're businesses operating in a challenging environment with real costs, real overhead, real risks. The problem isn't that dealers charge premiums. The problem is that most traders don't understand what those premiums mean. A dealer like Bullion by Post, they're paying for retail storefronts, Google advertising, staff salaries, insurance, security, compliance, payment processing. All of that costs money, and that money comes from the premiums. So when you buy from them, you're not just buying silver, you're paying for their entire business infrastructure. Is that wrong? No. Is it the best use of your money? Probably not. Here's the strategic framework that every silver buyer should understand. If you're buying for long-term wealth preservation, buy from secondary markets. Hold for years. Sell when you actually need the money. If you're buying for short-term speculation, don't. Just don't. The premiums will kill you. If you're buying because everyone else is, stop. Wait. Let the panic subside. If you're buying because you understand the fundamentals, good. But still buy smart. Use the silver forum. Avoid VAT where legal. Never pay more than 10% over spot. Daniel closes his laptop. The Buy Now button remains unclicked. He's learned something valuable tonight, not from buying, from almost buying, and then stopping. He realizes now that the best trade is often the one you don't make. He'll wait. He'll watch. He'll learn the secondary markets. And when the time is right, when premiums normalize, when panic turns to rationality, that's when he'll buy. Not because the price is going up, but because the value is there. Robert, on the other hand, is already planning his next move. He's seen how the market works. He understands the arbitrage. He knows where the opportunities are, but he also knows this won't last forever. Eventually, the information will spread. More people will discover the silver forum. More people will avoid retail dealers. More people will understand the VAT trap. And when that happens, the arbitrage gap will close. The premiums will normalize. The market will become efficient. But until then, knowledge is the edge. And those who have it will profit from those who don't. The silver market at 100 plus per ounce is not what most traders think it is. It's not an opportunity. It's a test of patience, a test of knowledge, a test of discipline. Most will fail. They'll buy at the top, pay maximum premiums, and lose money, even as silver rises. But a few, a small few, will understand what's really happening. They'll buy intelligently, sell strategically, and profit, while others panic. The question is, which group will you be in? The choice, as it always has been, is yours. But now, at least you know the trap exists, the path around it is clear, and the market is waiting. Daniel closes his laptop. The Buy Now button remains unclicked. He's learned something valuable tonight, not from buying, from almost buying, and then stopping. He realizes now that the best trade is often the one you don't make. He'll wait, he'll watch, he'll learn the secondary markets. And when the time is right, when premiums normalize, when panic turns to rationality, that's when he'll buy. Not because the price is going up, but because the value is there. Robert, on the other hand, is already planning his next move. He's seen how the market works. He understands the arbitrage. He knows where the opportunities are, but he also knows this won't last forever. Eventually, the information will spread. More people will discover the silver form. More people will avoid retail dealers. More people will understand the VAT trap. And when that happens, the arbitrage gap will close. The premiums will normalize. The market will become efficient. But until then, knowledge is the edge. And those who have it will profit from those who don't. The silver market at 100 plus per ounce is not what most traders think it is. It's not an opportunity. It's a test of patience, a test of knowledge, a test of discipline. Most will fail. They'll buy at the top, pay maximum premiums, and lose money, even as silver rises. But a few, a small few, will understand what's really happening. They'll buy intelligently, sell strategically, and profit while others panic. The question is, which group will you be in? The choice, as it always has been, is yours. But now, at least you know the trap exists. The path around it is clear, and the market is waiting.